This week is about to be insane in the stock market. We have Microsoft, Google, Meta, and Amazon all reporting their earnings this week. In this video, I want to share what stocks I am watching this week and give you my quick opinions and thoughts on them before we head into earnings and really the big earnings season. I also do my best to cover as many earnings as I possibly can here on my channel, so make sure to subscribe if you want to see my analysis and my opinions on these stocks throughout the week as they report. The stocks that I am watching in specific are Coke, Spotify, NextEra Energy, Microsoft, Google, Snapchat, Visa, Meta, Hershey, and Amazon. So let's start off from left to right with Coca-Cola. Coke stock is now down roughly 20% from its all-time highs, and the stock is seeing quite the correction right now. Coke is also one of the best and most well-known brands in the entire world. And the reason that I watch Coca-Cola's stock and pay attention to its earnings is because I see it as kind of a proxy for how consumers are handling inflation and how Coca-Cola is handling inflation as well. Warren Buffett says one of the best businesses to own during high inflation is a strong brand. And personally, I think that Coca-Cola is again one of the strongest brands in the entire world. However, Coca-Cola is not really a stock that I am looking to own anytime soon because I don't really think that the stock is that cheap right now. If we head over to Stock Unlock's Freeform tool and take a look at Coca-Cola's price to operating income, which I do think is one of the best metrics to follow for this business, we can see that it is trading for about 18.7 right now, and its 10-year average is about 19.4. So the stock is actually selling below its historical price ratio averages, but I still don't think that this is a very attractive business that is going to produce incredible returns for me in my portfolio if I was buying it at today's share price, even though it is selling at a slight discount. If we also take a look at Coca-Cola's trailing 12 months dividend yield, we can see that it's about 3.37% right now, which is above its average of 3.1% over the past 10 years, but this still isn't that high of a dividend that is getting me super excited to be buying this stock. Also, if we go and take a look at Coca-Cola's revenue, we can see that it is not at an all-time high right now. It has been slightly growing since about 2021, but the revenue really hasn't done that much over the past decade. This is kind of the same story with the company's operating income. It is at a high right now of about 12.6 billion, but it hasn't been really growing at anything super incredible or exciting for me. If we now head over to Coca-Cola's cash flow statement, this is kind of the same story with the operating and free cash flow as well. They've done about $11 billion in operating cash flow in the trailing 12 months, but all the way back here in 2015, they were also producing about $11 billion in operating cash flow. So basically, over the past 8 years, the cash flows haven't really grown for this business. So I think that paying a price ratio of around 20 for a business that's not really growing that significantly isn't really offering me that much of a return. Typically, if I'm going to pay a 20 price ratio for a business, I want to see a little bit more growth, or even honestly some significantly more growth. So Coke is not personally a stock that I am going to be looking to buy unless the share price comes down quite a bit. But again, I do still watch this stock because I think that it is a good proxy for how consumers are handling inflation and really how businesses are handling inflation as well. Now, moving on to the next stock that is going to be reporting earnings, this one is Spotify. Spotify is down roughly 60% from its all-time highs, so this business is still in a massive, massive correction. Now, if we head over to Stock Unlock's insight scores, we can see that Spotify does have a insight score of only 2.2, which is considered pretty bad. We can see that the financial health of the business is a 3.0, which is just average. The current ratio is fine. There's not a lot of debt. Shares have increased slightly over the past year, but nothing crazy. However, as we continue to scroll down, we can see that the growth score is only 1.75. Revenue and gross profit are increasing, but operating income, net income, operating cash flow, free cash flow, and book values are declining. So yes, the revenue is going up, but the business's profitability isn't really going up with the revenue, which I do not really love to see. Spotify also has a profitability score of only 1.8. The gross margin is 25%, but the operating margin, net margin, and free cash flow margin are all negative or basically 0%. So this business doesn't really generate any profits. Yeah, the revenue is growing, but again, there's just no profits really to be seen. The management score is also only 1.22, which is pretty bad. Stock-based compensation is quite high relative to the amount of profits that the business generates. ROIC is negative, ROCE is negative, return on equity and return on assets are negative, and the stock has underperformed the S&P 500 over the past 3 and 5 years. So management is basically taking on a lot of stock-based compensation and not really doing a good job at growing the business, its profitability, and its share price for shareholders. Now, if we head over to Spotify's income statement, we can clearly see that its expenses increase with the revenue. The revenue is the green bars on the right-hand side, and then the business's expenses are the orange and red bars on the left-hand side. And when the orange and red bars are above the revenue bar, it means that the business is actually unprofitable. And again, you can see that the expenses are growing with the revenue, so I'm not really sure when this business is going to become super profitable for its shareholders and actually start producing cash for them, but in the meantime, it looks like the business is not really generating any cash. In fact, if we head over to the cash flow statement, we can see that the cash from operating activities, also known as the operating cash flow, is only sitting at 42 million euros in the trailing 12 months now, and it is consistently declining. So it looks like the business's operations are actually struggling to produce a profit right now as well. So until Spotify can prove to me that this business is able to generate profits and return cash back to its shareholders, I'm going to be sitting on the sidelines and just waiting. Spotify is a business that I personally use, and it is a business that I pay for. It's a subscription that I pay for. I really enjoy the platform and their services. I don't really see myself switching anytime soon. However, just because I am a consumer of the business and I use their product does not mean that I need to own its stock. Because currently, I actually don't think the fundamentals of this business are looking very attractive. So in the meantime, I'm not going to be buying the stock. I'm watching it, I'm interested in it, but it's just not quite there yet for me personally. Now, moving on to the next stock that I'm going to be watching this week, this one is NextEra Energy, which is a utility company that has been dominating the market over the past couple of decades. If we actually enter in the SPY ETF right here and compare NextEra Energy's versus the SPY ETF, we can see that NEE has massively outperformed the S&P 500 despite it being in a pretty significant dip right now. NextEra is up roughly 938% over the past 20 years, and the SPY is up roughly 200%. So yes, this is a boring utility company, but its historical returns have been incredible for its shareholders. Now, if we zoom in, we can see that the stock is down roughly 44% from its all-time highs, which is a pretty significant correction, especially for a utilities business. Utilities in general have been getting hit hard in the market with rising interest rates because these businesses typically take on a lot of debt to continue funding their expansions. So if interest rates are rising and they have a lot of debt, it means that their debt is going to become more expensive and start eating into the company's overall cash flows and profitability. So personally, I think that a lot of people are becoming bearish on utility companies and selling off all of them, so the entire sector is seeing weakness. However, when a whole sector sells off together, it can create discounts on the high quality businesses within that sector. And NextEra Energy could arguably be one of those high quality businesses. So let's now quickly head over to the company's income statement, and we can see that the revenue is sitting at an all-time high right now, and it does look like it has started going up quite rapidly in the past couple of quarters. Now let's move on to the company's cash flow statement and take a look at their operating cash flow. So the operating cash flow is near an all-time high of 8.23 billion, but it's not really growing that significantly, and it actually hasn't really grown over the past 3 years. But now let's go and take a look at some more metrics here, and I will show you all why I was not a buyer of NextEra Energy and why I was waiting for a significant correction in its share price. So if we look from February 2010 to December of 2021, we can see that NextEra Energy's price to operating cash flow compounded at 15.4% per year. Now, if we also add in the stock price and the operating cash flow per share and scroll down here, we can see that the operating cash flow per share has only grown at 3.36% over this time frame, whereas once again, the price to operating cash flow, or the price ratio, expanded at 15% per year. And overall, the stock price did grow at roughly 19% per year, but the vast majority of the stock price returns was from multiple expansion over the past decade. And this is really why I wasn't so interested in the stock, is because the stock historically was performing well due to multiple expansion and not really due to actual fundamental growth on a per share basis. And I did not think that the price ratio could continue expanding at 15% per year forever, because if it did, then eventually NextEra Energy would be trading for a price to operating cash flow of 100 or 1,000 if this just went on for forever, you know what I mean? So in other words, I thought that the price ratio expansion would have to stop and eventually come back down, and when it did, that would ultimately create some weakness in the stock price and a potential opportunity. We can now see that the price ratio has in fact started coming down, but it's still around 13 right now. And NextEra Energy's average price ratio over the past 13 years has been about 11.5, so it is still trading above its historical averages. Now, one thing I also want to point out is a high quality utilities business, which is Fortis, is trading for a price to operating cash flow of only 7.75, which is also more in line with how utility companies typically trade. So NextEra Energy, relative to other utility companies, is actually still quite expensive. Now, what's also interesting about this is if we take a look at these businesses' operating cash flow per share growth, we can actually see that Fortis has been compounding its operating cash flow per share at a faster rate than NextEra Energy as well. So basically what I am seeing is Fortis seems to be a higher quality business that is actually growing its per share metrics more rapidly, or its per share fundamentals more rapidly, and it's trading for a significant discount to NextEra Energy. So yes, NextEra Energy does seem like it could be a high quality utility business, but a large portion of this stock price appreciation was simply due to multiple expansion over the past 20 or so years. And now I am still waiting for the stock price to continue coming down to maybe in line with how the overall utility sector is trading before I become interested in it. But now let's move on to the next business that is going to be reporting this week, and this one is a massive one. It's Microsoft, which is arguably one of the best businesses in the world. However, Microsoft has had the same thing happen to it as NextEra Energy. So let's go and take a look at some of its metrics, and I'll show you why I haven't been a super big buyer of Microsoft recently as well, and kind of what I am waiting for first. So if we go to Microsoft's price to free cash flow over the past decade, we can see that it has also expanded at a compounded annual growth rate of roughly 16%. Now, if we take a look at the business's free cash flow and stock price, just like we did with NextEra Energy, we can see that the free cash flow has compounded at about 8% per year, and the price to free cash flow again has compounded at 16% per year. So the majority of Microsoft's historical price returns over the past decade have once again come from multiple expansion. Again, I do not believe that this can continue forever, which ultimately means that I think the next decade returns for Microsoft are going to be significantly lower than the historical or previous decade, because the previous decade had a massive tailwind of multiple expansion that I don't think is going to happen over the next decade for Microsoft. If we also take a look at Microsoft's price to free cash flow right now, it's sitting at 40.6, which is still a very high price ratio for such a large business. I mean, a 40 price ratio for a business growing at 8% annually is a large price tag to pay, in my opinion. What this ultimately means is that even if Microsoft's price ratio stayed at 40 and its business compounded its growth at around 7 to 8% per year over the next decade, then the share price returns would probably still be only around 7 to 8%, which isn't really that exciting for me personally. And personally, I would also not be surprised to see this price ratio start to contract over the next decade as well, and start to come down to the company's historical averages, which have been about 20 to 25. So yes, Microsoft is one of the best businesses in the world, and it is near certain to continue growing its business in the future. But as Benjamin Graham has said, obvious prospects for physical growth to a business do not translate into obvious profits for investors. If you overpay for growth, then you take on significant amounts of risk, even if that future growth materializes, because you're already paying for it today. And if you want to learn more about this concept and why that is, then make sure to go and watch my last video, the Seth Klarman video, because he discusses this in an interview, and I provide some real world examples of why high prices are dangerous even on businesses that do end up growing over the next few decades. But now let's move on to the next stock that is reporting on Tuesday after the close, which is Google. Interestingly, Google's share price is back near all-time highs, but it's not quite making an all-time high quite yet. Now, if we head over to the company's financials and we go over to the income statement, we can see that the revenue is at an all-time high right now, but the revenue growth has definitely slowed down over the past about year. Now, if we move over to the company's cash flow statement and take a look at the free cash flow here down at the bottom, we can see that the company's free cash flow in the trailing 12 months is now at an all-time high of about $71 billion. So the company is producing a record amount of free cash flow right now. If we also take a look at the quarterly view, their most recent quarter was a record amount of free cash flow for the business by far, producing nearly $22 billion in free cash flow in just the second quarter of 2023 alone. It was a very impressive quarter for Google. Google is an interesting company as well because it tends to improve its margins when the economy is slowing down. So I do expect Google to continue improving its margins and maybe even posting another record quarter for free cash flow, if not near a record quarter for free cash flow in the quarter coming up here. And I'll show you what I mean here. So let's go and take a look at Google's free cash flow margin from about 2006 to 2009. So in the first quarter of 2007, they had a free cash flow margin of 15.16%. And then by the end of 2009, the free cash flow margin expanded to 36%. So throughout the entire Great Recession or the financial crisis of 2008, Google was actually focusing on improving its efficiency and becoming a much more profitable business. which again is what they're starting to do right now. So if we also take a look at Google's free cash flow during this time, we can see that from 2007 to the end of 2009, the free cash flow increased significantly as the company's margins were expanding. So now if we go back to the free cash flow margin, we can see that once again, this is what Google is starting to do. The free cash flow margin is starting to spike up and it's now at about 24.6%, but I do expect the company to continue increasing its efficiencies and expanding its margins over the next couple of years while the economy is slowing down. This ultimately means that Google can become a much more profitable business and a much stronger cash flowing business without really needing to grow its revenues all that much. All it really needs to do is continue increasing its profit margins, and the business can continue to produce more and more profits for its shareholders. Now, another interesting thing about Google is it's not even trading for a ridiculously high price today either. If we take a look at the price to free cash flow over the past decade, the average has been about 28.6, and Google is now trading for about 24.4. So it is still below its historical averages. And what's also interesting is Google's price ratio has not grown at a ridiculous growth rate over the past decade, only at a growth rate of about 2.24%. So a large portion of Google's stock price returns historically have actually come from the business's fundamental growth, unlike what we're seeing right now with Microsoft and NextEra Energy. We can see here that Google's free cash flow per share has compounded at about 18%, while the price to free cash flow has compounded at about 2%, so the vast majority of the stock price returns have come from the fundamental growth of the business and not price ratio expansion. Therefore, Google isn't nearly as expensive as Microsoft right now. It's selling below its historical average price ratios. Its returns have come from actual fundamental growth, and in my opinion, this stock could produce better returns over the next decade than a business like Microsoft, especially if they can continue increasing their margins over the next few quarters as well. So that is why I personally am more bullish on Google's stock going forward, and that is why it is in my own personal portfolio and why Microsoft is not. Now, moving on to the next business, this is Snapchat. Snapchat is a company I watch for a great example of a business I do not want to own. If we go and take a look at Snapchat, we can see that its stock unlock insight score is 2.13, which is pretty dang bad. The company's financial health is good, sitting at a 4.0, so the balance sheet is strong, but the growth is sitting at a 1.38, the profitability is sitting at a 2, the business is not really profitable, and the management score is a 1.20. There is massive stock-based compensation going on. I mean, look at this. 32% of the revenue that Snapchat generates goes to stock-based compensation, which is diluting shareholders and paying management. That is a ridiculous amount of stock-based compensation going on. ROIC is also negative 30%, and the business is just not really growing and it's not really profitable. So it's not really a business that I am interested in, but it is a good case study, again, of a business that I do not want to own. And if we quickly head over to Snapchat's income statement, just like Spotify, you can see that as the revenue grows, so do the expenses for the business. So this business, I'm not sure if it's ever really going to become profitable or return cash to shareholders, but in the meantime, it's not really able to do so, and it is doing a ridiculous amount of stock-based compensation to pay the insiders of the business and make them quite wealthy. Yeah, not really a business I am interested in, but I do pay attention to it to see if my negative thesis on it is going to play out and if my negative thesis can be right as well. Now, moving on to the next stock, this one is Visa. Visa is a ridiculously good business, and we can see that it is selling near its all-time highs right now. So if we go and take a look at Visa's insights, we can see that it has a score of 4.28, which is very good. This is a very high score on Stock Unlock. Dividend score is 4.83, financial health is 2.8, so kind of average. Growth is 4.0, but take a look at this profitability. 80% gross margin, 67% operating margin, and 60% free cash flow margin. This is the highest free cash flow margin that I have ever seen on a business. I'm pretty dang sure. That is a ridiculously high amount of profits that this business generates for its shareholders. We can also see that the management score is 4.40, so the management seems like it is protecting and growing shareholder value. For example, we can see here that stock-based compensation as a percent of revenue is only 2%, and stock-based compensation as a percent of free cash flow is below 4%. So there's a low amount of stock-based compensation going on relative to the amount of profits the business actually generates. Return on invested capital is also 40%. Return on equity is high, return on assets is high, and the company has outperformed the S&P 500 historically. So management is doing a great job over at Visa as well. So now let's go and take a look at how Visa's stock price is trading today. Well, the stock is trading for a price to free cash flow of about 25, and its historical average has been about 31 over the past decade. So the stock is trading below its historical averages right now as well. It's actually trading about in line with Google. So Visa and Google are trading for about the same price to free cash flow right now. So in my opinion, I do not think that Visa is overly expensive right now, and it is a very high quality business. I personally just don't own it because I don't understand the payment space too well, so it's not a stock I am looking to own at the moment, and I would want a bigger discount or a larger margin of safety for my own sake, since I am not very confident in this industry specifically. But in general, I do think that Visa is a high quality business that is not trading for a significant premium today. Now, the next stock we're going to talk about is Meta, the infamous Meta right now. Meta is right back near all-time highs, trading for $314 a share, which is just remarkable. I mean, this stock is now up roughly 250% from its lows just back in November of 2011. That is a huge swing in value for this business, a mega cap stock within just 1 year. It's absolutely insane. So let's take a look at the business now. We can see that its revenue is sitting near an all-time high, but the revenue hasn't really grown in almost 2 years now, as the business's expenses have been creeping up. You can clearly see that the expenses bar is going up while revenue is kind of stagnating. Now, if we move on to the cash flow statement, we can see that operating cash flow is right near all-time highs and starting to uptrend once again. Meta is doing what Google is doing and focusing on getting its margins back up so it can produce more cash flow for its investors. And the company is executing on this. The free cash flow and the operating cash flow are in fact increasing once again and going right back up near all-time highs. Now, personally, I would like to see this trend continue. So in Meta's earnings that they are going to report this week, I'm going to be looking for continued margin expansion and continued cash flow expansion as well. And I want to see the cash flow continuing to trend up. Now, if we go and take a look at Meta's price to free cash flow, it is sitting at roughly 33 today, which is a massive expansion from the 9 it was selling for in November of 2022. This is ridiculous. A 9 price to free cash flow for Meta. That was a serious discount on the stock. However, the discount, in my opinion, is arguably completely gone now. And at a 33 price to free cash flow, this business is starting to price in future fundamental growth. So it's not really such a cheap stock anymore. And it's definitely not as cheap as it once was. So this is a stock that I am continuing to watch, and I may re-enter it if the price does drop down enough. But at current price ratios, this is not a stock that I am really eager to start buying. But it is a stock, again, that I am watching and could potentially see in my portfolio one day again in the future. But now let's move on to the next business, which is Hershey. And this is a business that I have seen a lot of people discussing recently. And this is probably why right here. The stock is in a 30% drawdown within just the past couple of months, which is a huge drawdown for such a large and well-known business. Hershey has been around for over 100 years and has some incredibly strong brands within its portfolio, like Reese's Pieces, which is my favorite chocolate bar. So seeing such a strong, fundamentally sound business trading for a 30% discount from its all-time highs does look quite interesting, and that is why I'm going to be paying attention to its earnings. Now, if we head over to the company's income statement, we can see that over the long term, the business's revenue does consistently grow. It is in a little bit of a dip right now, but again, the long-term trend for this business is clearly going up and to the right. Now, if we head over to the cash flow statement and we take a look at operating cash flow, this is the exact same story. The company's operating cash flow is in a little bit of a dip right now, but overall it is right near all-time highs, and it does continue to grow over the long term. So now let's go and take a quick look at Hershey's price. And it is trading for a price to free cash flow of roughly 24 today, and its historical average has been roughly 24. So the company is trading right near its historical average price ratios, and personally, I do want more of a discount on the stock before I become super interested in it. Yes, this business is pretty high quality, and yes, I understand the business. I'm a consumer of the business. I really like some of its brands and products, but I just want a little bit more of a margin of safety when I am buying this stock. It is in that 30% correction, and I am going to be paying attention to its earnings to see if there is some new developments or if the business is still growing quite strong. Now let's move on to the final stock that we got to talk about today, which is Amazon. Now, interestingly, Amazon is not back near its all-time highs like the other stocks such as Microsoft and Google. The stock is actually still down roughly 31% from its all-time highs, so it's still in a pretty big correction. However, if we head over to the company's income statement, we can see that the revenue is sitting at an all-time high right now. And if we go over to the cash flow statement and take a look at the operating cash flow, we can say that it is going right back near all-time highs as well. It was in a pretty big correction in 2022, but then the company pulled a Meta and Google and said, hey, we're going to be focusing on getting our cash flow back, we're focusing on getting our margins back, and we are going to be focusing on profitability. And you can see that the operating cash flow has been coming back in a big way. And I do believe that Amazon is going to start producing record amounts of operating cash flow before the end of the year. Now, if we head over to Amazon's price to operating cash flow, we can also see that it's trading right around 20, which historically has been near the lows that this business likes to trade for. Its historical average price to operating cash flow is around 28, so it is trading for a pretty big discount to its historical averages as well. I also do have a video on my channel explaining why I look at the operating cash flow for Amazon, as it is the metric the market seems to follow the most closely. And it is the metric that the market seems to price Amazon and value Amazon based off of. But overall, I am looking for Amazon's operating cash flow to continue increasing in the next quarter, and for its operating cash flow margins to continue expanding, and hopefully for cash flows to go back right near all-time highs and start producing all-time highs once again. But those are all of the stocks that I am going to be watching this week, and I'm going to do my best to do as many videos as I can on these businesses and cover their earnings as they come out. So again, make sure to subscribe to my channel if you want to stick around for that. Also, I do plan on having Chapter 4 of the Intelligent Investor series done and out by this weekend. So if you are someone who is following my Intelligent Investor series, where I'm going through the book chapter by chapter and pointing out everything that investors need to know, then again, there will be a new video coming out this weekend, so make sure you subscribe to the channel if you want to see that video as well. The Intelligent Investor is a very challenging book to read, which is unfortunate because it is the best book on investing ever written, and I believe that a lot of people miss out on all of the gold and lessons that are contained within the book. So I started this series on my channel to help investors learn from the book and be able to extract all of the gold that is within it. So again, if you are interested in that series, then I would strongly recommend watching it, and I will have the new chapter out by this weekend, or on the weekend, I should say. But that is going to wrap up the video, everyone. So thank you so much for watching. As always, I truly do appreciate it. And if you did enjoy the video, then please remember to leave a like on it as well, because that does really help. But that's going to wrap everything up. So thank you all again so much for watching, and I really hope to see you all again in my next one.